Recently, I've had a lot of questions about dividend investing, particularly with the new NISA starting up. So let's talk about it. Dividend investing is a really popular investing strategy that's often talked about online, and lots of people are interested in it. So, today I'd like to go into a bit of the details with dividend investing, talk about how you might be able to do it, and compare it with index investing, which, in my opinion, should be the default option for most people. So let's take a look at dividend investing. So, first of all, what is it? So, dividend investing is buying shares or funds with a view to receiving dividends. And dividends are basically money that companies pay out. Basically, they take some of their profits and they return it to their owners, the shareholders, in the form of dividends. Now, normally dividends are expressed as a percentage of the share price, and you can easily look them up online. Dividends can be paid annually, twice a year, quarterly, even monthly. Each stock or fund is going to treat that differently. And what we're trying to do when we build a dividend paying portfolio is we're trying to choose companies and funds that will pay out dividends into the future. We want the dividends to be consistent, to be sustainable, and to be able to receive them as a dependable income source. Ideally, the companies and funds that we choose are going to increase the dividends over time so that our dividend income will go up as time goes by. So why do dividend investing at all? Well, some people find it really comforting to have a kind of income stream so that they don't have to sell their investments in order to get money in retirement or to live off their investments. With dividend investing, you can receive your dividends and you don't have to sell the investments. As long as your dividend income is enough to live on, then that is you sorted. You don't really have to think about your investments very much. So how can we get started with dividend investing? Very simple. Just start buying companies or funds that pay a dividend. You can buy these in a taxable account or you can buy them in a NISA account. In order to do dividend investing in a NISA account, we'll have to use the growth portion, the Seicho Bubun, which has a 2.4 million yen a year annual allowance and a 12 million yen lifetime allowance. So we could build up a dividend portfolio using 12 million yen and thereafter get the dividends from that for as long as they were paid out. So what are the drawbacks of dividend investing? And I'm going to split this into two sections: the drawbacks while growing your investments and the drawbacks while drawing down your investments. So while growing your investment, I think we can illustrate this with an example. So this year, or rather last year, there's a very small number of companies have provided most of the growth in the American stock market and even the world stock market. They're called the Magnificent Seven. These seven kind of technology companies have grown incredibly. However, these companies, because they're growing, tend not to pay dividends. In fact, only 3 of them are paying dividends currently, and they're only paying dividends at a very low rate of under 1%. And this is quite normal. So generally speaking, larger, more mature, slower growing companies will pay a dividend because they can't use the money effectively themselves, so they're going to return it to the shareholders. Smaller or faster growing companies are not going to pay dividends because they can use that money to reinvest in the company and grow it faster. So by pursuing dividend investing, we're kind of losing out on the potential for growth and these kinds of outsized gains that are not going to happen with more mature dividend paying companies necessarily. So basically, the 3 main drawbacks for dividend investing, in my opinion, is that you're likely to get a lower return than the market return because you're choosing companies that are more mature or larger and they're paying out dividends. This strategy requires more work because you have to find the stocks and the funds that pay dividends, and you also need to keep an eye on them in order to make sure that they continue paying out their dividends. They're not going to stop paying dividends or lower the dividend and so on. This requires a bit of time and a bit of brain capacity. And finally, this strategy is a bit less efficient. So if you buy a mutual fund in Japan, for example, where dividends are reinvested internally, that fund can grow within your NISA account, within your iDeCo account, without using up your annual contribution or without using up your lifetime contribution. Compare that to a dividend stock or fund where the dividend is paid out. You get the dividend and then you reinvest the dividend into the company. You're going to use up your allowances. And if your investments are not in NISA, it's even worse because you are taxed on your dividends. So company pays the dividends out, you pay tax on the dividend, you put in the smaller amount of money back into the company to grow it, and so on. You're losing out on the amount you paid in taxes, and compounded over years or decades, that could be quite a lot of money. Now, dividend investing is actually quite good for people in retirement because it's quite a simple strategy. However, there are risks, and the biggest risk is that the companies that you chose or the funds that you chose end up reducing their dividends, or they stop paying dividends, or even they go bankrupt, resulting in a loss of not only the dividends but also the capital that you put in the first place. Compared to index investing, I think dividend investing is not a good choice for many people. With index investing, you're likely to get a higher return. It's going to take a lot less work. You're going to have to spend a lot less time on it. And it's much more tax efficient. And also it's a better use of your NISA or iDeCo accounts. Even if you're interested in building a dividend portfolio and so on, I still recommend that you keep at least some of your investments in indices. And over time, you may well find that the performance of the index investments is better than the performance of your dividend paying stocks, and that might give you an idea on how you want to change things in the future. This happened to me a couple of years ago. My portfolio used to be a combination of indices and dividend paying stocks, but I just found it too complicated in the end, and I got rid of all my dividend stocks, moved everything into world stock indexes and developed country bond indices. So my take on dividend investing is that it's quite interesting and some people like the idea, but I don't think it's for everyone, and I'd recommend that most people just stick with index investing. Now, there's one thing about the new NISA that makes it more attractive for this kind of dividend strategy, and that is the fact that you can reuse your lifetime allowance. What that means is that you could invest in mutual funds now for the growth, and then later, once you get into retirement and you want to build an income producing portfolio, you could sell your funds and buy dividend paying companies later within the NISA. So you can sell some of your NISA investments that were in mutual funds and use that regained lifetime allowance to buy dividend investments that will pay income in retirement. And that might make sense for some people as well, because you're getting the growth while you want the growth, but later on when you want stability and you want income, you can switch your strategy from index investing to partially dividend investing. How about you? Where do you stand on the dividend investing versus index investing debate? Do you agree with my conclusions? I'd love to hear your thoughts in the comments. And of course, if you've got a question, if anything wasn't clear, please leave that in the comments as well. Thanks for watching, and we'll see you in the next video.